As we all know, 2022 has been a really difficult year in the market as no sector hasn't been negatively impacted by this bear market that started back on June 13th. That was 162 days ago, and since the average bear market lasts approximately 289 days, we're only a little bit over halfway through this volatile season. Of course, that's only if this bear market is typical. It could be over much sooner or much later. And that probably depends a lot on whether or not this inflation will stop growing or not. But of course, we all know the market's been bad for a while, even before we officially entered this bear market in June. The entirety of 2022 has been a really big challenge in regards to share prices. As both a dividend and an income investor, I say all the time on my channel that to investors like us, share prices aren't the most important thing in regard to investing. Now, obviously, you don't want to invest in a stock that's taking a nosedive because it could be an indicator that the company's in a really dire situation. But in general, more importantly than share price changes is the ability of a stock or a fund to be able to maintain their dividend payments. If share prices are going down, it's actually good news for us because if we're buying more shares or reinvesting dividends, it means we can pick up more shares or fractional shares at a discount. And this year's given us a great opportunity to pick up some really great stocks and funds at a really sizable discount. But the reality is, it's much worse to have a stock's dividend get reduced for investors like us. It's especially true if you happen to be living off your dividends, because then your dividends are part of your livelihood. If you have a sizable chunk of your portfolio invested in a company that has a sizable dividend cut, it can mean having to reduce living expenses or something even worse than that. That's why all investors, regardless of your investing preference, should diversify and make sure that you have other holdings to rely on if you do experience a dramatic dividend cut. But certain holdings don't always pay a consistent dividend, but instead pay different amounts each quarter or each month. So for example, this is usually the case for covered call funds, royalty trusts, as well as some closed-end funds. But for the sake of transparency, one of my holdings just recently went through a dividend cut of its own. I monitor every holding I talk about on my channel that I own to make sure that it's still in a healthy position to pay dividends. But not since the COVID plunge in 2020 did any of my holdings go through a dividend cut. So in today's video, I'm going to go over which stock I own and endorse that just recently had its dividend cut, why it happened, and I'll also go into why this sector the company operates in is currently going through a really difficult season right now. I'll also give my opinion on where this company is headed in the future. So with that being said, let's go ahead and get started. The company that just had their dividend cut was Sachem Capital, ticker SACH. They're a real estate finance company that's involved in originating, underwriting, funding, and servicing short-term mortgage loans. Sachem invests in properties located primarily in the northeastern part of the United States as well as Florida. They offer loans to real estate investors and owners to fund their acquisition, renovation, rehabilitation, development, and/or improvement of residential or commercial properties. The typical period of their loans range from 12 to 26 months, and they're non-secured bank loans that are sometimes referred to as hard money loans. They're a pretty small company when compared to their peers, and they were founded back in 2010. I've covered this stock 3 times in this channel's history, with the first being in August of last year. I dedicated an entire video to Sachem Capital back in May of this year, and I brought it up a third time a little over 3 months ago. When I first discussed this stock last year, it was paying 12 cents per share every quarter, which it eventually grew to 14 cents per share. But on October 27th, the company announced that they would be reducing their dividend distribution next quarter from 14 cents to now 13 cents. So they only cut it by just 1 penny, and it still pays more than the first time I brought it up on this channel. I don't really know why the management team decided to pay 14 cents per share back in July if it wasn't sustainable. They would have been better off just keeping it at 13 cents because the fewer the dividend cuts you have, the better. Sachem Capital is structured as a mortgage REIT, which is a real estate investment trust that either issues or invests in mortgages. They could actually invest in mortgages and/or mortgage-backed securities depending on the company. There's a lot of different types of MREITs out there, so not all of them function in the exact same way. Some MREITs only invest in MBSs, whereas some issue their own mortgages. Some MREITs own both mortgages and physical properties like equity REITs do. Some of these companies invest in residential mortgages, whereas some invest in commercial, or a mixture of both. Finally, some invest in assets that others don't, like mortgage servicing rights, so not all of these types of companies are created equally. But all of them share a few characteristics. For example, all MREITs are required by law to pay out 90% of their earnings to shareholders in the form of dividends. By doing this, most of these companies don't have to pay corporate taxes as long as the majority of their earnings get passed on to investors. Because of these rules, MREITs are typically a really popular type of holding for people who enjoy receiving high dividend payouts. But a downside is if you're looking for share price growth, you typically don't experience that with these kinds of stocks. Many of them offer yields between 8 and 12%, but more often they don't usually grow their distributions. There are a couple of exceptions, but for the most part, most of the growth you'll experience will only come through reinvesting your dividends if you choose to do so. But even worse for MREITs is that a lot of them tend to do really poorly in high interest rate environments like what we're going through right now. It's because when interest rates are high, it lowers their net interest margin, or the difference between their interest income and their interest expenses. Another reason is when interest rates are high, the value of mortgage-backed securities falls if the MREIT is investing in MBSs. So far this year, we've seen a number of mortgage REITs reduce their dividends, including Invesco Mortgage Company, Broadmark Realty Company, and Chimera Investment Corporation. Other high-yielding investments like business development companies and master limited partnerships have actually been able to grow their dividends this year. So Sachem isn't alone in the mREIT sector that's seen a dividend cut this year. Right now, their stock currently trades for $3.80 per share, which makes them a penny stock. It currently offers a yield of 13.68% according to Google, which is extremely high even for an mREIT. Given how much the market is down this year, I'd say around 9 to 11% is pretty typical. But at over 13.5%, this is exceptionally high and therefore should be treated as a riskier holding within this already risky sector, which is what I always believed about this company. It's a pretty small company with a market cap of just $155 million. The largest mREIT, which is Annaly Capital, has a market cap of over $9.3 billion as of the making of this video. But the reality is the housing market right now is putting pressure on this company, and your opinion on the housing market should be the largest motivator as to if you want to consider this stock or not. Everybody has their own opinion on whether or not the housing market is about to go through a similar situation like it did back in 2008. Some people think we're in a huge bubble that's about to burst, while some people think it won't be as dramatic. I tend to be on the side of housing prices will probably keep falling, but it's not going to be anything dramatic like it did back in 2008. Sachem claims that in housing markets they invest in, the home prices have actually been increasing. I know in a lot of housing markets right now, prices have been falling due to high interest rates, turning a lot of buyers away. Because they issue loans for fix and flips and new constructions, these are both sectors of the housing market that are suffering a lot right now. There was an article on CNBC just a few days ago that mentioned how home sales have fallen for the 9th straight month in a row, which isn't helping this company. Since their founding, Sachem's been making larger moves, including operating in more markets and increasing their average loan amount. Another good thing about this mREIT is that they offer a lot of short-term loans, which helps reduce risk. Sachem offers bridge loans, which are a really short-term type of loan that someone will take out while they search for longer-term financing options. These can be pretty profitable because, again, they're very short-term, and the reason why these loans are taken out in the first place is because someone wants to borrow for a longer period of time. You have to be pretty confident in what you're doing in order to take out a bridge loan in the first place. Going forward, my view of Sachem hasn't really changed since I started investing in this company. For me, it's always been a little more on the speculative side, and it's always been one of the smallest holdings in my portfolio. I don't have any plans on selling this stock, and I tend to ride things out since my exposure is so small right now. I've been impressed with the amount of growth this company has gone through, but I'm definitely not calling this a growth stock. They can only grow so much because they are structured as an mREIT, but I'm hoping this company can experience more growth in the future because another mREIT that specializes in bridge loans, which is Arbor Realty, has gone through an insane amount of growth over the years. If things do get a lot worse in the housing market, then Sachem is going to struggle a lot. But I'm a believer that housing prices aren't going to go through a really dramatic price drop. I also believe that interest rates are going to start cooling off sometime early next year. I have such a small investment in Sachem right now that I probably will pick up a few more shares and keep reinvesting my dividends. But like I said, it's largely a speculative investment for me. If you're interested in Sachem Capital, then be sure to perform your own research and come to your own conclusion before investing. Your belief on interest rates and the housing market should be the driving factor as to whether or not you want to pursue this stock or not.